Yo, what's up, everybody? Today we got episode 5 of Macro from Zero. Today we'll be going over how to read central banks. So, statements, press conferences, forward guidance, data dependence, and it's like a connection, everything together. So, without further ado, we just gonna start right here with opening. So today we put the final piece in place. In episodes 1 through 4, we covered the data, interest rates, inflation, labor markets, GDP. You now understand the inputs. Now today we cover how to read the interpreter. Central banks do not just react to data. They communicate about it, they guide markets' expectations, they signal future moves before making them, and in modern markets, what a central bank says is often more powerful than what it does. I already can read. This is so annoying. I don't know why. But yeah, sorry if I can read today. But we'll continue. A well-crafted press conference can tighten financial conditions without moving rates a single basis point. An ambitious statement can cause 200 pips of volatility in seconds. Learning to read central banks is not optional for serious forex traders. It is the skill that separates those who understand macro from those who just react to it. So, anatomy of central bank statement. Every 6 to 8 weeks, the Fed releases a statement after its FOMC meeting, around 500 to 700 words. Markets have been waiting 2 weeks for it. It moves every major USD pair the moment it drops. The rate decision line. Already known from future markets, the real content is everything that follows. The economic assessments describes current conditions, growth, labor market, inflation. The language is deliberate. Compare it word for word against the previous statement. Changes are signals. If the previous said inflation remains elevated and the new one says inflation has eased somewhat, there is a dovish shift. Every word matters. The balance of risks. Risks described as a tilted upward on inflation are hawkish. References to downside risk to growth are dovish. The forward-looking language, the most important part, further policy firming may be appropriate. Signals more hikes. The committee will take into account the cumulative tightening. Signals they are nearing the end of the cycle. The vote count. Anonymous means nothing unusual. Dissents tell you the direction of internal pressure. Dove dissents signal the committee is hawkish. Hawk dissents signal dovish pressure is building. Forward guidance, how it moves markets. Forward guidance is when a central bank signals what it expects to do in the future, one of the most powerful tools in the toolkit. Financial conditions are shaped by expectations, not just current rates. If the market believes the Fed will raise rates 3 more times in the next year, long-term bond yields rise today. Mortgage rates rise today, the dollar strengthens today, all before the Fed has moved rates at all. This is called doing the Fed's work for it. Calendar-based guidance. We expect rates to remain at the current level through at least mid-2025 explicit. The market knows the timeline, used heavily during COVID. High impact but high credibility risk if broken. State contingent guidance. Sorry about it. We will keep rates low until inflation reaches 2% and the labor market has healed. Conditional on outcomes, more flexible for the central bank but harder for markets to price. Implicit guidance through language. No explicit commitment, but the tone signals direction. This is what most central banks do most of the time and requires the most interpretation. The credibility problem. In 2021, the Fed's guidance said inflation was transitory and the rates would stay low. When they abandoned this and hiked aggressively, massive volatility and credibility crisis. Markets do not forget broken guidance. The hawkish versus dovish spectrum. Every piece of central bank communication sits somewhere on a spectrum from very hawkish to very dovish. Learning to place each communication on that spectrum is the core skill. Hawkish signals. Upward revisions on inflation forecasts. A labor market described as strong or robust. Risk described as tilted upward on inflation, emphasis on commitment to price stability, fewer expected rate cuts in the dot plot, the phrase further policy firming may be appropriate, dove dissents, hawks are unified and doves are the ones dissenting. Dovish signals, downward revisions to inflation forecasts, growth described as slowing or softening, references to downside risk to the outlook, emphasis on the employment side of the dual mandate, more expected rate cuts in the dot plot, the phrase, the committee can afford to be patient. Hawk dissents, internal pressure for cuts is building. The key nonce. Relative changes matter more than absolute changes. A statement that describes inflation as elevated but easing is more dovish than the one that says inflation remains elevated. Even though both acknowledge high inflation, the direction of the language change is what moves markets, not absolute level. Hawkish surprise versus dovish surprise. A hawkish surprise is when communication is more hawkish than expected. This is when you get a big move, 100 to 200 pips in the first 10 minutes. A dovish surprise is the reverse. No surprise, expect the buy the rumor, sell the news reversal. What data dependent actually means. Sorry. You will hear this phrase more than almost any other. For most of 2022, 2023, 2024, and 2025, practically every major central bank described itself as data dependent, all of them, all the time. On the surface, it means we do not have a preset path. We will make decisions based on incoming data. It sounds humble, flexible, responsive. But here is what traders need to understand. Data dependence means the market has to price in every incoming data point as a potential catalyst for a rate move. CPI, NFP, GDP, every single release becomes a potential policy moving event. It keeps markets in permanent anticipation and amplifies volatility on every release day. Data dependence also signals the central bank's confidence level. A bank that gives clear forward guidance is confident in its economic forecasts. A bank that says data dependent is acknowledging uncertainty, and uncertainty means volatility. How to use this in practice? When the Fed says data dependent, track the specific data they say matters most, and they will tell you if the chair says they are watching core PCE carefully, that is your signal. Trade core PC releases as direct policy moving events. Follow the central bank's lead on which data is driving decisions right now. The data that matters shifts over the cycle. In 2022-2023, it was CPI and NFP. Once inflation fell, attention shifted to labor market health. In 2025-2026, with inflation re-accelerating under wash, the focus shifted back hard on inflation measures. Reading the press conference. The statement drops and markets move. Then 30 minutes later, the chair stands at the podium and takes questions, and sometimes they move markets even more than the statement did. The opening statement, the chair reads a prepared statement first. Listen for anything new, any word not in the written statement, any emphasis that was not there before, even a slight change in the tone in a signal. The Q&A, journalists push the chair into saying something more specific than the written statement allows. Pay attention to three things. What the chair refuses to rule out. If asked, could you hike in September? And the answer is, I will not take anything off the table. That is a hawkish signal. The market reprices immediately. Sorry again. What the chair is reluctant to confirm. If asked, are you confident inflation is returning to target and the chair hedges heavily, that is a dovish signal. Confidence in the path has correct. Tone of certainty versus uncertainty. A confident direct chair signals conviction in the current path. A hesitant, heavily qualified chair signals internal uncertainty and raises the chance of a surprise at the next meeting. The 2026 Warsh lesson. After his first FOMC meeting in June 2026, ING, MUFG, and SAB all called the press conference confusing and lacking a clear anchor for inflation. That ambiguity itself was a signal. The reaction function had changed. Uncertainty had increased. Every subsequent data release would be amplified in market impact. The minutes and the speeches. Beyond the statement and press conference, two more communication channels matter enormously. The minutes, published 3 weeks after the FOMC meeting. They provide a detailed account of the deliberations, what was discussed, which arguments were raised, how close the vote was, even if anonymous. The minutes often reveal internal debates not visible in the statement. If they show several members favored a larger move or wanted to pause earlier, that tells you the internal balance of opinion and where the committee might go next. Speeches. Between meetings, the Fed governors and regional presidents give speeches. These are planned communications, not off-the-cuff remarks. When a hawk gives a speech titled "The Case for Staying Restrictive," there is a deliberate signal. When a dove gives one titled "The Cost of Over-Tightening," also a signal. The most important speeches come from the chair and vice chair. Chair speeches at major events, like the Jackson Hole Symposium in August, are used to signal major policy shifts ahead. The Jackson Hole speech in August 2022 was where Powell explicitly committed to bringing down inflation regardless of the economic pain. Markets dropped sharply. The dollar surged, one of the most consequential central bank communications of the decade. Track all of these statements, press conferences, minutes, and speeches. Together, they give you a 360-degree view of where the committee is heading before they get there. The toolkit. Tracking central bank communications. Here's exactly how to track central bank communication as a Forex trader. FOMC statement released same day as the rate decision. Read it against the previous statement word by word. Mark every change, every addition, every deletion. Changes in language are policy signals. Fed chair press conference. 30 minutes after the statement, watch or listen live, focus on the Q&A, track market reaction in real time alongside the conference. FOMC minutes. Released 3 weeks after the meeting. Read the sections on economic conditions and monetary policy deliberations. Look for phrases like many members versus a few members. These indicate the weight of opinion within the committee. Dot plot released quarterly at the March, June, September, and December meetings. Shows where each member expects rates to be at year end and beyond. Compared to the previous dot plot, shifts in the median dot are market moving events even without a rate change. Fed speeches. Tracked via the Federal Reserve website and Bloomberg. Most important, the Jackson Hole Symposium. In August, ECB Forum in Sintra, Portugal in June. Also watch Bank of England MPC speeches and ECB Executive Board speeches between meetings. Fed Speak Tracker. The Fed's own website lists upcoming speeches. Mark the ones from the chair, vice chair, and key regional presidents ahead of each FOMC meeting. A speech that contradicts the recent statement is a signal that a surprise is coming. So, conclusion. Let's look at the full picture. Interest rates, the engine, inflation, the primary fuel, labor markets, the second fuel, and the amplifier, GDP, the scoreboard, and central bank communications, the interpreter. The layer that tells you how the central bank is reading all of the above and what it means for the next rate move. Macro trading is not about reacting to data, it is about understanding how the central bank will react to data and positioning before they do. When inflation is hot and the labor market is tight and GDP is strong and the central bank is signaling highs, the currency strengthens. When those forces flip and the central bank communication confirms it, the currency weakens. The traders who consistently make money on macro moves are not smarter, they read better. They read the data, they read the statement, they listen to the press conference, they track the minutes, they follow the speeches, they compare language, look for changes, and position ahead of the repricing. That is the complete macro framework for Forex. 5 episodes, use it. Stay tuned and watch the next videos to see how I put all of this into action. So I just want to point out there is a free Discord server, first link in the bio. So if you have any questions about this or anything other, just feel free to join and ask me there, or just give a comment. I will also respond to comments under videos. And yeah, just subscribe, like, and I'll see you in the next video. Bye.